Healthcare companies have attracted private equity investments worth 27,000 crores in the past 2 years. Top transactions show that private equity players are interested in the Indian healthcare space due to factors such as low bed count versus other countries, rising awareness and insurance penetration post-COVID-19, and India becoming a medical tourism hub. But what happens when a private equity player takes over? Ekta Batra gets us more on that. Ekta.
Thanks for that. Well, promoters of hospital companies generally take on PE funding in lieu of further debt. The money is to fund their high capex requirements along with the intent of bringing in more efficiencies and to monetize their stake. When a PE firm takes over, governance such as strengthening of the board and the C-suite and fiscal discipline are top priorities. PEs improve the P&L and balance sheet by reducing costs, improving quality, strengthening sales and adopting technology. Now, a few examples of success stories in the healthcare space include when PE firm CVC took over the cancer hospital chain Healthcare Global's operations in 2020. The company's cash from operations improved from just breaking even to around 200 to 250 crores and debt reduced to around 150 to 200 crores versus 700 crores. The company's market cap has risen 2x since the investment. For Max Health, the company saw its market cap rise by 5.9 times from the time the PE firm KKR along with Radiant picked up 49.7% stake for around 2,120 crores in 2018. The new management led by Ajai Soy focused on operational efficiencies with margins rising from 9.7% in FY19 to 27.2% in FY22 with a 41% EBITDA CAGR in just 3 years. Similarly, unlisted chain Care Hospital saw its EBITDA rise from around 98 to 100 crores to 323 crores in 4 years of TPG taking over. Other success stories have included PE firms rapidly growing brands such as Asia Healthcare Holdings, expanding their cancer chain CTSI, Nova IVF and Motherhood Women's and Children's Hospital. It's important to remember PE firms undertake all these changes to maximize returns when they look to exit, which is their ultimate goal. The investment time frame of a PE or VC is generally 5 to 7 years. However, the exits can be as soon as 3 years if the return thresholds of 2.5 to 3 times are achieved. One of the most successful exits in the hospital and clinic space, which saw 17 exits in FY23 worth around $2.5 billion, was KKR cashing out of Max Hospitals in just 3 to 4 years with an almost 5x return, the most lucrative since the PE firm started operations in India over 25 years ago. Other notable exits in the space include Carlyle exiting Medanta, British International Investments exiting with an 8.67 times return in Rainbow Hospitals, and homegrown PE Everstone exiting from Sahyadri Hospitals. The interest in the healthcare sector, which saw 99 deals in 2 years and is now 5% of the PE capital flow into India versus sub 2% pre-COVID-19, is expected to continue. A few examples include 8 Road Ventures launching a $250 million healthcare fund last year, to TPG creating a multi-speciality healthcare delivery platform with Blackstone, where TPG will own 25% and the remaining with Blackstone. And yes, while promoters might not like the change and say it disrupts their vision, one must remember that the nature of the capital itself, which is a PE firm itself, is to drive change, formalize the operations, and eventually look for a profitable exit.
All right, to discuss more on the growing interest of PE players in the healthcare place, on the other side of the break, we'll be joined by Kaivaan Movdawalla, who's the Indian healthcare sector leader and partner at Ernst & Young, and B.S. Ajai Kumar, the executive chairman of Healthcare Global Enterprises. Stay tuned.
Discussion about the PE investment in the healthcare space. We have Kaivaan Movdawalla, who is the India healthcare sector leader and partner at Ernst & Young, and we have B.S. Ajai Kumar, who is the executive chairman, Healthcare Global Enterprises, joining in. Gentlemen, thank you very much for taking the time out and joining into this conversation. Mr. Kumar, let's start with you because you, in fact, have experienced a PE firm investing into your company, CVC, which invested in 2020. Can you tell us about what were the changes that took place in healthcare global briefly on a financial metric perspective?
Thank you for having me. We have had several PE firms in HCG since 2007-8. But when the last PE group, which has come, CVC, at that time the important thing was it was brought stability as far as the fiscal area, because this was post-COVID. The $90 million which came helped us to reduce the debt and brought about kind of financial stability for us, because we were not sure how the COVID will impact. So CVC coming in really helped us a lot in terms of that. And we had several centers which were new, and some of the centers were mature. And new centers were obviously in a negative EBITDA. So we were able to withstand that and really come out of it very well because of the PE investment, and really made a big difference for us in terms of how we came out post-COVID. It helped us to stabilize and also to grow substantially after that, as you have shown.
Okay, so you're saying it helped you to stabilize and grow substantially, the kind of PE investment you got in your business. But Mr. Ajai Kumar, just help us understand a little more about what you mean by grow substantially. What kind of growth metrics are you looking at? And how is it different from the situation before you got the investment?
No, we always had a PE investment. We were a listed company, but we were growing at 15-20%. But what happened, because our growth was quite strategic and we had growth happening in multiple cities at the same time, we are putting centers in Mumbai, Calcutta, Nagpur and other areas. And they were all new centers. And so what happened after the PE came in CVC was we were able to financially, make sure it was not coming in the way of our growth strategy in terms of putting in the necessary capex, necessary infrastructure, digital health, marketing. All of that was done very well because of the funds which came. And of course, as you said very well, they also brings, we were always fiscally disciplined being a listed company. That was not a problem. But the perception also in the market was HCG had a lot of debt and there were some perceptions. Right or wrong is a different matter. But CVC coming in also helped the market perception in a positive way. So we believe it made a substantial difference for us, not only in the stock price, but also in the growth consolidation. We were in the consolidation mode and we were able to consolidate very well in the 3-year period since they've been here.
Okay. All right. Kaivaan, wanted to come to you with regards to the PE interest, because we just saw another deal take place just yesterday where India RF, which is basically backed by Piramal as well as Bain, they invested or they bought a majority stake, controlling stake in a regional hospital in the north for around 525 crores. So we're almost hearing of deals either on a bi-weekly or, monthly basis when it comes to this entire space. Can you tell us what the pipeline looks like henceforth?
Sure, I think the PE juggernaut really continues to roll on, right? If I talk about numbers pre-COVID, the PE VC investment flow into healthcare was somewhere in the range of $800 to $900 million. In 2021, that jumped to $2 billion. In 2022, it jumped to $2.6 billion. And in 2023, where we are right now, 8 months, we are already upwards of $4 billion. And that's on the back of the blockbuster Manipal transaction that happened a few months back, a few single specialty transactions around Indira IVF, Maxivision, and the one that got announced yesterday. I think this momentum is going to continue. Additionally, when you look at the M&A front as well, I think this year itself has had 50 M&A transactions in this space in 8 months versus 200 in the last 2 years. So clearly, this path of consolidation is going on. And with the kind of returns that investors are seeing, the kind of performance that the sector has really demonstrated, a few more will surely be up pipeline in the next few years.
Actually, that's the big question, right? I mean, the investments come through, but what is the kind of exits that these investors are getting and at what rate? So you said that the returns are good, Kaivaan. Just trying to understand, because now there's also a funding winter that's going on, with this entire VC, even PE space. So tell me, what is the kind of returns that you're seeing on these deals?
Yeah, so we've seen in the last 2 years at least, and you've showed your statistics as well, it varies anywhere between 3x to 5 years, 3x to 5x over a period of 3 to 5 years. So that's the kind of return, and which is why, compared to a 5-year horizon, you're also seeing some of the funds exit within a 3-year or a 4-year window with a 3x return over a 3-year time frame, which is phenomenal. And that's really on the back of the real secular demand supply drivers that the sector is really presenting to all of us as a country.
Okay. Well, Mr. Ajai Kumar, coming to you, while we have spoken about a lot of the interest and the positives when a PE enters, what is the downside risk of a PE entering? Because the end goal, Mr. Kumar, is to actually exit with returns. So somewhere it's almost a clinical sort of decision making which comes through as well. So what's the downside risk of a PE?
I think the important thing is the downside risk of a PE is they have to understand the healthcare, working with the medical professionals, doctors. IMA as HCG was founded as a doctors group, and doctors are the backbone of all this. While I as a promoter am a doctor, we have 400 doctors in HCG. Important for PE to understand that how we can work with the doctors' medical quality outcome. I always say medical quality outcome, the data-driven, what is the outcome of this hospital chain compared to others, that makes an enormous difference even in the revenue flow. Obviously, patients will come where there is a good outcome, where there is a good medical care. So the PEs have to focus on that. Month to month, quarter to quarter numbers, while they may be important, that should not be basis. The downside is when PEs don't understand this, and they go for a EBITDA margin. I always say EBITDA margin of 25-30% as a group is very high. We should really stick to EBITDAs in the low 20s. And there, I think, is where we feel we are really patient-centric. We are looking at patient, and this is an understanding any PE has to have. So PE, when we choose PE as a promoter, we should also be careful in choosing the right PE who understand this concept. There are different types of PEs. The right PE coming into the right institution is the hallmark of a success where both work together as a team and bring about patient care success as well as financial success.
Okay, well, thank you, gentlemen, for stopping by and discussing this entire, healthcare space and the kind of PE investments that we've seen in the space. Mr. Ajai Kumar, Kaivaan, thanks a lot for joining us. Let's step into a quick break. On the other side, Manish.